In this video, we'll dive into the staggering scale of the Bank of Japan's intervention and discover why the 160 yen level has emerged as a critical battleground for global markets. Recent reports reveal that the BOJ sold an impressive $70 billion to halt the yen's decline. So, is this the dawn of a sustained effort or merely a frantic attempt to stave off a historic collapse? The Japanese yen has plunged to its weakest real effective exchange rate ever, even falling below the Turkish lira when adjusted for reality. This drastic depreciation draws eerie similarities to the 1980 Rokichi bond crash, where a mix of oil shocks and rapid tightening triggered chaos. Now, with the 10-year JGB yield soaring to 2.8%, we find ourselves navigating uncharted waters in Japan's economic landscape. In late April and early May, we witnessed a staggering $70 billion FX intervention aimed at stabilizing US dollar to Japanese yen around the 160 threshold. Traders are on high alert for another wave of intervention, especially with liquidity thinning during the holidays. Experts are eyeing 159.75 as a potential trigger point. While the pair has rebounded from its post-intervention dip, the risk remains high as the BOJ gears up for further tightening to protect the currency's value. Market chatter on X is charged with tension. ING Economics warns that this could just be the beginning of a long campaign to defend the 160 ceiling. Traders like Neil Sethi are concerned that low liquidity during the holiday season in London and New York heightens the chances of sudden intervention. Interestingly, history shows that every time the yen's real rate has reached such extremes, a surprise rate hike from the BOJ has often followed. A structural change is unfolding in the bond market. For the first time in 3 years, the BOJ's share of JGB holdings has fallen below 50%. This retreat coincides with the 10-year yield hitting 2.8%, the highest in nearly 30 years. Prime Minister Takai's talk of a supplementary budget for energy subsidies has only added to market skepticism, as investors question the fiscal math behind these moves while yields for ultra-long-term bonds approach 4%. Despite the turmoil surrounding the currency, the Nikkei 225 has soared past the 60,000 yen mark. This remarkable rally is fueled by substantial foreign capital inflows and the stellar performance of AI-related megacap stocks like NVIDIA. While some caution that we may be heading towards a bubble reminiscent of 1929, others argue that today's tech giants are, unlike the dot-com era, generating real profits. The market now poses a choice: hold on to depreciating cash or invest in concentrated equity winners. The surge in Japan's domestic yields is sending ripples through the U.S. market. As the largest foreign holder of U.S. treasuries, Japanese institutions are compelled to sell off their holdings to reassess their positions. This selling pressure is pushing U.S. Treasury yields higher, leading to losses in U.S. bond ETFs. This synchronized rise in long-term yields across the UK, Germany, and the U.S. underscores a broader trend of fiscal turmoil and escalating government borrowing costs. For individual investors, the June BOJ meeting is crucial. Historical events, like the 1976 UK IMF crisis and the recent Turkish experience, show that half-hearted policy measures can lead to a swift loss of confidence. As we look to the future, the high interest rate environment appears set to persist for several years. The challenge of protecting against inflation while managing market volatility will define investment strategies in 2026. In our base scenario, the BOJ is expected to maintain a gradual approach to defend the 160 level while slowly increasing rates, keeping the Nikkei stable around 60,000. In a more optimistic scenario, a surprise hike in June could quickly stabilize the yen, unwinding carry trades and curbing inflation, allowing the real economy to catch up to stock prices. Conversely, a bearish scenario could see a fiscal mishap where JGB yields surge past 3%, prompting more U.S. Treasury sales and potentially triggering a global bond market crash between 2025 and 2026. To wrap up, the BOJ is deeply involved in a massive $70 billion defense. JGB yields are soaring to 30-year highs, and the Nikkei has reached a historic 60,000 mark. The upcoming June meeting will be a critical juncture. What do you think about the 160 yen line? Share your thoughts in the comments, and don't forget to subscribe for more in-depth macro analysis on Japan.